Whether you like it or not, the tax season is upon us. So in this video, I'm going to be telling you all you need to know about taxes on your stock market investments. Cue the intro. Who am I kidding? I don't have an intro. Hey everybody, Arjun here. Welcome back to the channel. Many of you have been leaving comments on my videos asking about taxes on stock market investments. So here I am bringing you not one but two videos on this topic. The first one is more about basic tax information on capital gains and dividends. And then the second one will be about how to file taxes, including, what software to use, how to go about it on different visa statuses and all that good stuff. But for today, let's just focus on that first part. And mind you, all of this is for the US only. Right off the bat, when you buy a stock, there are no tax consequences. So this also means if you buy a stock and hold on to it and just watch its price rise, you do not owe any taxes on that. It's only when you sell the stock and realize some of those gains that taxes come into play. And the amount of taxes you owe depends on how long you've held the stock. If your stock is bought and sold within the same year, then you're taxed at your ordinary income tax rate. So if you're in the 32% tax bracket, you'll have to pay 32% tax on your gains. Notice how I said gains here. That just refers to the difference in price that you sold for versus the price that you bought for. And if that totally doesn't make sense right now, don't worry about it. I do have an example coming up that should clear things up. But for now, just know that if the buying and selling happens within the same year, then it's called short-term capital gains. So all of those pump and dump trades from GameStop and AMC these last few weeks would fall under this bucket. On the other hand, stocks that are bought and sold after 1 year are taxed at much lower rates. For most people out there, that's going to be around a 15% tax rate. And this is what we refer to as long-term capital gains. Let's jump to that example I was talking about. Assume that Arjun is in the 24% tax bracket and buys a stock today. He buys one share for $100. Let's look at two scenarios. Scenario 1 is 9 months later. The stock price has moved to $200 and Arjun decides to sell his stock. His gain here would be $100, and since he's in the 24% tax bracket, he would have to pay $24 as taxes, leaving him with a net of $76 post-tax. Scenario 2 is 15 months later. The stock price is still $200 and Arjun decides to sell his stock. His gain would be the same at $100, but here he only has to pay 15% in taxes since he qualifies for long-term capital gains. This means he only pays $15 in taxes, leaving him with a net of $85 post-tax. Basically, the lesson we learn from all this is that it can be quite advantageous to keep your stocks for a longer period of time since you pay less in taxes. In this example, you only end up saving $9, but you can imagine the impact when you're investing thousands and thousands of dollars over many years. This is one of the reasons I take a more long-term approach to my investing. Whenever I'm building out a position, I don't look to, quickly make trades and make a quick buck. I prefer to hold on to my stocks for at least a couple of years. If you're looking to invest, I will leave my Webull link down in the description box below. And when you sign up using that link, you get 2 free stocks, so please do check that out. One more important thing to point out, you're not always going to have gains. The stock market is not this magical money-making machine. You can have losses too. But the saving grace is that stock losses offset stock gains. For example, if you made $500 selling one stock and lost $300 selling another stock, you only have to pay taxes on the net gain of $200. If this net amount is negative, meaning you have losses for the entire year, then you can write off these losses up to $3,000 every year against your taxes. There's just no escaping Uncle Sam. You have to pay taxes on the dividends you receive as well. Majority of investors will be getting qualified dividends, which are taxed at the same rate as long-term capital gains. So again, that would be 15% for most investors, unless you're at either ends of the income spectrum. All this just goes to prove how much the tax rules are stacked up against the little guy. The investors get all the favorable tax benefits versus the regular W-2 employees. If you earn an extra $10,000 from your job, you're taxed at the highest tax slab. But if you make that same extra $10,000 from your long-term investments, you end up paying much less in taxes. This is how Warren Buffett pays a lower tax rate than his secretary. Can you believe that? Most of his income comes from long-term capital gains and dividends, whereas his employees get regular W-2 income, which is taxed at a higher rate. This is why I keep repeating in every video how important it is to not just save money, but invest it and put it to work for you. Don't worry if you didn't fully understand all the specific tax details. Your brokerage should summarize everything in a 1099 form. So this will have all of your buys and sells, your capital gains, your interest, your free stock, and it's all nicely summarized in a PDF form. All you have to do is go into your brokerage, download it, and you can plug this straight into your tax filing software, and it basically takes care of the rest. As I said earlier, I'll be talking more about the tax filing process in the video coming up next week. So make sure you have the bell notifications turned on and you've subscribed to the channel so that you don't miss out on that video. So far, everything I've spoken about relates to taxable brokerage accounts. If you're doing all of your trading within tax advantaged accounts, so that would be your 401ks, your IRAs, and your HSAs, you do not owe any taxes right now. For traditional 401ks and IRAs, taxes are deferred, meaning you pay taxes only on withdrawal. And for Roth IRAs, you pay no taxes at all. So that's why the general rule of thumb is to prioritize these tax advantaged accounts if you know that you won't be needing the money for a while. I know a lot of you have gotten into crypto over this past year, and you do owe taxes on your crypto transactions as well. So this follows the same system as stocks. You have the same short-term capital gains and long-term capital gains. But just keep in mind that if you've either mined crypto or you've bought and sold items directly using crypto, then taxes can get a little more nuanced. Look, taxes are something that we all have to deal with. I know that it is not glamorous, it is certainly not fun, but I also know that understanding the basics does go a long way. I hope this video helped at least a little bit on that aspect. If you do feel the same, please gently tap that like button and also keep an eye out for part 2 that's coming up, because there is definitely a lot of value packed in that video. Leave any questions you have for me down in the comment section below, and please also share this video with your other smart investor friends. Have a great rest of your morning or afternoon or evening whenever you're watching this, and I will see you in the next one. Peace.